It's not how much cash that you're putting into the policy, paying your premiums that should equal income, equal premium. It's what is coming out of the policy, that guaranteed cash flow that you're able to receive from that policy. And I was like, boom, it totally clicked.
If everyone took policy loans like what you and I teach, insurance companies would have a problem. And I think that needs to be talked about more. As much as I love the concept of becoming your own banker, if everyone did it, the question would be, would the insurance companies be able
sustainable?
Sustainable, and I would say no.
If I can help solve your need for financing cash while you're living, you will have enough death benefit to your family and heirs.
Hannah, welcome to the BetterWealth show.
Thank you. Thanks for having me.
I just interviewed your dad. I'm not sure if this is going to go before or after, and I gave him a compliment because there's people like Chris Noggle, Mr. Burr, and others who might actually be more known on social media than your dad, but your dad was the one that was the person behind the scenes making it all happen. So before we jump into exciting topic of infinite banking, whole life insurance, money mindsets, and a lot more, what is one thing you admire about your dad that you've applied in your own life, and like how is your life enriched because of your father?
Yeah. I would say there's kind of 2 points there. One thing, and I'm definitely a daddy's girl. I've learned that growing up, but also too, as now because you have a daughter. Probably April's gonna go through this, but when your daughter's a teenager, you and the mom and the daughter, they just kind of butt heads. But now, like, even my mom is like my best friend, like in my lifetime. But I think one thing that I take away from Pops is, number one, I think just his huge heart, wanting to just share and give to people. Because his background, he never really had that growing up. I mean, yeah, his parents were very loving, very caring, but they had some hardships. And even going through all those hardships, he still came out with a humbleness, a kindness to him that he just wants to share with other people as well. So I think that's one of the biggest things, is that just his huge heart that he always wants to give. And then also, I would even just say how direct and blunt he can be. You need those people in your life. Yeah, girlfriend, you kind of do look a little fat in that dress. It's okay. And I think definitely in today's society, we're a little, I guess, what's the right word? Like, where we don't want to be that authentic self just because sometimes, you're scared of what other people might think of you or might say about you. But I think that's one of the biggest things about Pops, is that I love how blunt and direct he is. Yeah, sometimes he's made me cry before because of how direct he is, but I think that's a great character trait that he has that hopefully I'm also delivering when I'm speaking with clients or my friends, my family too.
Yep. He said that he started his first policy in 2008.
Mm-hmm.
Do you remember that? Or
Not a whole lot, but I do remember the times before the policy, our lifestyle, and then the times even after the policy and what really changed. I would even say not just material items. I would say my parents' relationship got a lot better after solving money problems. And I think that's when it kind of clicked for me that, hey, I think something is going on here. They're doing something.
You
It's
probably
beneficial.
didn't know what they were doing, but they were probably spending a lot more on their lifestyle. And then once they started, this process, they paid a lot less. And so again, if you don't know what we're talking about, we'll for sure air your dad's episode before this, just so there's context. And so anyways, how did you get in this space? And like I wanna hear, you have your own channel as well. So I wanna hear some of the things that you're learning, what you're doing. We can dive into some of your insights around whole life insurance. It's interesting. This channel, people like hearing about that. I've interviewed lots of people, lots of colleagues. You're part of the Money Multiplier team, and so Chris Noggle, Devin Burr, your dad, and the Dews are all a part of your guys' amazing
My
team.
homies.
And so, again, if there's things that you're like, hey, these are insights, this is the Hannah way of explaining, or this is the insight, but I would love to hear just a little bit of your backstory of like why you decided to get into this space. And then what were some of your epiphanies? And then what were some of the things that you learned through the hard way about money and about your life?
Oh, no, for sure. Because, right, actually, my background, I even have an episode on this on my show. I have a podcast show, and I actually did a whole episode on the person behind the pod. And I think that resonated with a lot of people, just being open and vulnerable with your audience. Because I was a terrible kid growing up. I got into drugs, alcohol, partying, hanging around the bad crowd. I mean, it even got to the point that mom and dad almost sent me to military school. I actually I went to 3 different high schools, because for my sophomore semester or year, I went up to, Pittsburgh, Pennsylvania, living with my older brother for a little bit because dad was like, "I just don't know what to do with her. It's kind of out of control." So, I think what really clicked for me getting out of that phase is my older brother, he was actually living in an environment where it wasn't the best part of town. I mean, honestly, my getaway was going to the gym, and I could walk to the YMCA just down the street, but I'd be walking down there and you would see needles on the ground. I mean, it was that type of environment that I was living in. I was like, "Hey, I don't wanna be doing this." So then that's when I came home and really got my hopefully I can say this, but got my shit straight. So then after that, I was always very independent. So I never leaned in on mom and dad really for anything. I was really eager to even just get out of high school. I actually graduated high school early, and then from there, I got my first apartment when I was 17. Mom had to sign off on that apartment saying that she was the person leasing the apartment just to get out on my own because I just operated a lot better away from my parents. I mean, we still had a great relationship, but just living in the same household, it was just better for us to have our own living situations. But then, hey, I got to pay my bills, I got to pay the rent, pay the food. So then I was actually waitressing at Cracker Barrel, and I loved that gig. And I was the real deal. I had like 4 stars on my apron, okay? But I loved it. But being in that environment, you know, I really got the taste of career waitresses who've been there for 10 plus years fighting over $2 tips. It was kind of a weird balance because there would be young girls like myself who's, 17, 18, and then you have your folks who are, I don't know, 50s, 60s waitressing. So you kind of had those two groups. And, I didn't wanna have that mindset, and they were just so negative fighting over these $2 tables and, just kind of talking down to all the younger girls, right? And I'm like, "Okay, this is not my life. I don't wanna be a waitress forever and ever." And back then too, I was doing a little bit of school. I was going to a community college. I love math, and so actually I was gonna pursue, being a CPA, and so I was taking some accounting classes there, but I was like, this just isn't fulfilling me." So what I would notice is that my real passion is fashion design. So, back then, even there was one time and Pops was in the business, he was traveling around doing his live speaking. We went to Savannah, Georgia. He had an event in Savannah, Georgia, and I wanted to tour the SCAD school out there, Savannah College of Art and Design. And so we did that, and I was like, "Hey, this is something that I really, really wanna do." But then dad sat me down and he says, "Okay, but in order to do this, you're gonna have to go get some student loans. You're gonna have to go to the school for 4 years. And have you even looked up what fashion designers make?" I mean, back then, I would go get a student loan for what, maybe 200, 250,000, and then once I leave college, now I'm gonna go find myself like a
Well,
35,
for
40
a
year
designer, well, how much is
job.
college a year? That seems a little high d
It was right around like 100 for the year.
for the year.
So
For a
per
designer, and what's an average salary that someone's making as a
anywhere on the low end, 45, high end, 70.
so that's not a great investment,
And not a great
and
investment.
it's really hard to get a job. It's like, not only do they not pay, like, that well, but it's very competitive, and so was that like a good, by the way, great, and that's a great, experiment to do, just period. Like, whenever you're thinking about your future, look at the input of your time, money, all the energy that's going to go into getting you to what you want. Look at that as an investment. Say, like, what am I putting in? What am I getting out? And almost run a calculator on it. And not to say that something, if it calculates more than others, that makes it right. Like, you should do what you love, but at the end of the day, it at least is another factor that you should factor into a decision.
Exactly, exactly, and that's what I don't think, like, people my generation think about or even talk about. Yeah, because I was like, "Well, hey, I'm just gonna be working backwards now. I don't think I wanna do that. I kinda like my lifestyle that I'm living." So I said, "All right." Well, mom and dad actually called me up one day and they said, "Hey, well, we need help in the business. Do you want to help us? And if you don't want to help us, that's totally okay, but we're just going to go find somebody else." And I said, "Well, okay, well, what do you want me to do?" And then that's when I started off being an application specialist, taking all the applications for the policies, getting folks through the underwriting, which I think is like the best place that they really introduced me into the business because you got to understand how these underwriters think. There's so many practitioners or life insurance agents out there who are just want to go sell, sell, sell. But you got to understand how your person that you're in a partnership with actually thinks when you're going through the underwriting process to approve these cases, right? So I said, "Okay, well, let me help you." So then I was helping them do the applications, and then that's when I got the idea that, hey, well, now that I'm learning a lot more about money and wealth and keeping the wealth for myself, let's just play it this way. Let me go build up my resources, and then once I have those resources, I can now invest my time, money, and energy into these hobbies, like starting a boutique. Actually, my newest biggest thing is that I'm really into craft beer and just the science behind all the makings of the beer. So even in my future, I want to have like a barcade, so like a brewery arcade type of place, right? So all right, Hannah, let's get our resources straight first, and then we can go out and have these hobbies now. Hopefully, the idea is that those hobbies will be profitable, starting those businesses that'll still keep funding my lifestyle of what I'm doing now. But it's totally opposite and backwards to what we've been taught, right? All right, I should go out there, go to college, get a degree, and then, hey, once I'm out of college, I'm going to go find a really, really great job. A lot of our people that we know in our generation, that's not working out right now, is it? So, kind of forgot the question, but
Yeah, that's good. No, that's
that's
good.
kind of where I'm
I
at.
was you have your dad's ability to just start going. I love it. All right, so let's talk about yeah, obviously your dad's very passionate about life insurance and the process of banking using life insurance. So when did it click for you, and when was the what was the epiphany for you when it clicked?
Yeah, I think utilizing the policies.
Yeah.
I think the biggest thing is when I'm able to save the money, being able to control where I'm keeping it and not having to rely on others, whether it's banks or other people, to help me in a time of need. I mean, honestly, my first ever policy I started when I was 18 years old because that's when dad came to me and says, "Hey, you're old enough now because you got to be 18 in order to own a policy. Now that you're 18, you're going to start this policy and you've been saving up about $100 a week. That's 400 a month. So you're going to start your first policy 400 a month." And back at that time, I didn't know everything that I know now. And actually, I knew enough to understand like, okay, base premium paid up edition. Why are we overfunding the paid up editions and not and the base premium, right? And I actually even remember getting a little frustrated with dad because dad was designing my policy 60 base, 40 paid up edition. And then now kind of having that like epiphany sitting here right now thinking about it, I understand why some of my clients are even like, hey, I want as much cash value. I'll put it into the PUA because it's just their mind's not there yet. They're not thinking long
Well,
term.
what is the pitch of having a higher base?
So that later on in my life, I can keep funding that policy because the whole idea, right? And I guess where do I want to start? The paid up editions, they're going to have to be forced to drop off later on down the road anyways, right? Because you got to
Yeah,
drop them off to avoid the mech.
I'm assuming the first policy that he designed didn't have a term rider,
No
right?
term riders.
Okay, okay, yeah, then that's correct. Yeah.
Yep. So those paid up editions have to drop off later on. Well, aren't I using my cash values of my policy today to create me more wealth so that my income keeps rising? I have more cash flow that's coming into me, and I'm going to have a need to want to place and warehouse that wealth somewhere. And so I love high base premiums because at my life right now, 24 years old, going to be 25 in August, I got a long life to live and keep working. And so I'm not going to slow down, and I'm going to have a need to want to warehouse that money somewhere. And when I have those stronger foundational base premiums, I can keep storing the capital in there. And then that's really what keeps thriving the policy in those later years of its life. Actually, I'll tell you, I haven't even told my dad this yet, but right now I'm looking at a policy. I'm thinking about starting at about 10,000 a month. And I was really looking at this thing and I was thinking to myself, well, okay, Nelson always teaches us that your cash has to flow somewhere. Income and premium should equal. And actually, I had a really great conversation with the gentleman that we know, Mr. J-Lo, up in Canada. And I was asking him about that page. And I said, hey, what does Nelson really mean when he says premium and income should equal? And Jason really got me into this mindset that no, 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 it's not how much cash that you're putting into the policy, paying your premiums that should equal income, equal premium. It's what is coming out of the policy, that guaranteed cash flow that you're able to receive from that policy. And I was like, boom, it totally clicked. Because now, if I'm going to be able to start this policy, let's just call me 25. And when I'm 65, that's 40 years in the future. And so when I get to that time of 65, I looked at this thing, I'm cash flowing out at least 600,000 a year from just this one policy, not to mention my 7 other that I own right now. So, and on that policy, the reason I bring it up is that policy is actually built as a 50-50 policy. So that's why I just put so much into the base, just because it's the long haul. This is a lifestyle. It's a process that you're going to keep incorporating forever and ever. And so I'm just not going to stop.
Right. Do you, I didn't ask Chris, Stefan, or your dad this because again, like you're behind the scenes. You've started, in the underwriting, but like you understand product design and all. Do you guys still like? What is your philosophy when it comes to designing policies? Is that the case? Like higher base? Because yeah, I just want to hear your thoughts on that.
Yeah, no, no, no. Everybody's different. I always say that there's no one silver bullet out there. Somebody who's in that financial hamster wheel, living the paycheck to paycheck lifestyle, no, probably a high base premium's not gonna solve their money problems right now, because that's the ultimate goal. How can I solve your money problems? So some policies, heck, maybe they are a 25 base, 75 paid up additions, but that doesn't mean that their next policy may be 40 base, 60 paid up additions. So I don't think there's any right or wrong way when designing policies. I think it really comes down to what is that person's needs and goals, and how is this policy going to best suit that individual and where they're at.
Yeah. So then again, we should have part two where we go into the numbers on this.
Yeah.
We've had clients that have higher base, but that normally is because the death benefit deal. Normally it's like, hey, higher base because they have a death benefit play. They care maybe less about the cash value and more about the permanent death benefit. What I've seen when it comes to running the numbers, I have not necessarily seen that even having a higher base gives you the ability to save more when you include, a term rider, flexibility on that. And yes, we are projecting in the future 30, 40, 50 years. And yes, that term rider is expensive, but we're comparing it today. And so it would just be interesting to see like, okay, doing it that way versus maybe doing like a 40 or 50-50 blend. Obviously, I would just love to see long term and the pros and cons on that, because I think when Nelson wrote his book, I don't think he talked anything about term riders. And you could make the argument that a term rider is less conventional. It's something that you shouldn't do. I want to ask you a question about term insurance in a second, but what are your thoughts around that? And what have been some insights when you look at the policies, dive into the numbers? What has been like the overall, like, is there a design like the 40-60 is like that that Nelson talked about? Is that the thing that's like, hey, that's the default? Or are there, like, how is the money multiplier teams like generally looking when it comes to funding their policies?
No, honestly, all across the board, I would say my philosophy, if I don't have to add a term rider to a policy, I'm not going to add it. I would rather have my dollars going towards the base that builds me cash value, or my paid up addition rider. So even if I can design this policy like max split between the base and the PUA without causing mech, maybe it's like a 30-70 type of policy, right? That's in my personal preference, my favorite. Now, I got a lot of real estate investors that I work with. People will call me up all day long saying, "Hey, Hannah, I just sold a property or an investment got paid out, or maybe I have some inheritance money rolling in. I got this cash bucket of about $200,000, and I understand the importance of running it through my policy or my banking system first. But Hannah, I know I'm not going to do $200,000 every single year. I'm more comfortable doing, I don't know, 2,000 a month or 24,000 a year." So in those instances where folks are doing like dump-ins inside their policy, you got to add term riders because it just makes sense to it. But that's why I always say that there's not one silver bullet out there. I would say for my philosophy, if I got that person that's got that boatload of debt that they have going on, it's going to be more like a 25/75, and you're going to have to add term whether you like it or not in most cases. But if I got a person like, gentleman just got approved actually yesterday, he's 30, he's just wanting to save the money somewhere. He's really not in a cash flow bind. He just wants to save his money and then be able to utilize the cash for investment. So hey, that policy is designed just exactly how I described, max split between base and PUA without having to add term. So I just term, I understand that we can convert the term with most carriers, if not all, but you can convert that term into a permanent whole life policy. But I would rather leave open that insurability to be able to go out and get myself more
Yeah.
premium based PUA into new
Which
policies.
actually I want to I believe, and again, because you're saying, hey, I would rather have my dollars go to PUA or base towards policy. I see the term rider as the same thing. I'm giving myself the ability to put more into PUA, which, I would say from my ability to pay towards a permanent policy, it accomplishes something similar, and we could talk about efficiencies, pros and cons. But you do make a really good point. If you put a term rider on, you're increasing the death benefit so that you can stuff more into PUAs and it doesn't mech. The problem with that, and I know I'm throwing a curveball, problem with more death benefit, problem with that is if you're trying to put a ton of money into life insurance, like some of your clients are putting in almost all of the money that they make into that, you now hit a problem because the insurance company is going to say, well, we can't issue you any more life insurance because you can't be worth more dead than alive. So you have a first world problem in your scenario to say, oh, I can't actually fund more life insurance. So you do have a good point that if you have that philosophy, term riders can bump up your death benefit, which can create an ability where it's like you want to put more money into life insurance, but you can't. What you could do, though, is you could just find other people with insurable interests still own the policy. So it's like there's, and even your dad said like he owns policies on other people because potentially he's at that place where the insurance company doesn't want to issue more life insurance on his life. So
That's it.
it's just one of those things where like that is the one point that can acknowledge, because the having term rider does bump up your death benefit, which in a lot of cases, playing devil's advocate is a good thing. It's a really good thing, and that's one of the reasons I'm a big fan of it. Is you get your cake and eat it too. You get more life insurance and you get more liquidity. But again, if you're 7, 8, 10, 15 policies in, you may have to shift to another place.
Bingo.
So that's,
Well,
yeah,
and then actually that might be a great segue because I know you wanted to
yep,
talk about some term insurance. I love convertible term.
same,
Not a lot of
love it.
people talk about convertible term enough. They just it's straight term I think we need to get more educated on convertible term and because there's a lot of people that are way underinsured.
I agree. And that's what my question for you, and we actually own convertibleterm.com. I love that, and I'm excited to continue to leverage that domain and because I'm a fan of term insurance, especially the term insurance that gives you options that protects your family. Your dad was saying, he's like, hey, even if you had $200 a month, to fund. My question that I didn't ask him just due to time is, when do you say, hey, actually just buy convertible term, protect your family, give yourself the ability to convert when you have more? Unpopular opinion maybe, but like I don't really like to start a permanent policy. You can't fund at least $10,000 a year. I know that's crazy, but like, so we tend to take the approach, if you only have a couple $100 a month, get a term insurance policy, put the rest in a savings account, build up at least $10,000, and then front load a policy if you want to start. And so you have your protection, you have a front load versus paying like $200 a month. The downside of that is sometimes you lose momentum and that person might never do that. So I want to hear your thoughts around how you guys utilize term insurance. If someone has a low premium, like 100, 200, $300 a month, will you start a permanent policy, or do you make sure that their human life value is in place?
Hey, it's Caleb Guilliams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more.
No, well, and then here's my philosophy on that. Me personally, I just don't trust the banks. I don't like the banks. I don't like to keep my money down at the commercial bank. Personally, I don't even keep more than 3 months of my overhead expenses at the bank. If I see that there's more money sitting there and I'm not going to be using my money within about 60 days, I'll go pay back some policy loans just to safely warehouse the money over there. So I think that's where maybe I'm a little different in that sense, where I teach my folks that we should be saving or keeping at least 10% of our income. If somebody's profiting 100,000 a year, you should be saving at least 10,000 of it. That's 835 a month. So that's kind of where we start off by first, and you probably see this too. A lot of people don't know where their money's going, how it's flowing. I am a huge advocate of Rocket Money. I say it all the time on my show, Rocket Money, sponsor me. Because I use that app and I love it. It does all of my tracking. It tracks all of my spending, the different categories. And I'll look at it and say, ooh, Hannah, you kind of ate out a lot this past month. Let's kind of dial that back a little bit. But my favorite section on there is it tells me how much is left for savings, the dollar amount and the percentage amount. And that's how I know that I'm ready for another policy, because I've been on this incline of money's coming in that I'm like, hey, my percentage is going up and up. I need to move some of this money because I'm maxed out my other ones. But so when people come to me, that's what we kind of look at first, is their budgeting. Hey, are we keeping or saving at least that 10%? Now, I tell my folks to get started in this concept 10 times your age. If you are 50 years old, 10 times the age is $500 a month. Are you worth $500 a month to pay yourself first to go and put these monies inside of this policy? So 10 times the age is when people ask me, hey, what's the minimum to get started into this? But really, there's two other ways that I look at it. The first one is our net profits. Okay, so if I'm the type of person, let's say I'm profiting $10,000 a month and my expenses are $7,000, well, why am I leaving the leftover $3 at the local bank and the bankers are making profits off of my money? I'm going to start by shifting that to keeping the savings dollars. That's the money that's going to start flowing towards the policy. So that's kind of where I get them in the mindset of, hey, the policy is just our glorified savings vehicle. That's all that it is. But then also, for more of my upper income net worth people, what are you just spending in taxes this year? How can I recycle that money that I'm just sending to the government every year that I have to pay them? So why don't I just use my policy just to pay my annual tax bill? So that's kind of how I get them in the mindset of utilizing those baby steps to then project into
Have
the
you ever
funding the
had anyone get
lifestyle.
in trouble because they're too aggressive on life insurance, and then they're like, hey, they have outstanding loans, they things from an income standpoint fluctuate, and now they feel like they're kind of squeezed? Does that ever happen? Or
So it's happened once. I have one individual, but that's why I think it's so important to talk about the flexibility of the policy. Hey, can we at least make that minimum base premium? Right. So as long as they know that minimum base premium of, hey, this is what I have to save. Because even if someone's doing an annual premium, they can always switch it to monthly or do quarterly. Right. So that's always an option to create more
there's a lot of flexibility.
flexibility.
There's a lot of flexibility for
Mm-hmm.
sure. Question for you around term insurance. Do you guys recommend people getting their human life value in term insurance? Like, how do you address because you could fund $200, $500 a month in life insurance. The way that you structure it might only be like 300,000, 200,000, 400,000 of death benefit. You might have a family that might I hate using the word need, but from a needs analysis or a wants analysis should have 3 to 4 million.
Yeah.
How do you address that?
Yep. Well, and then that's where, even to go back on the last question, that's why it's so important that we have the implementation team, the mapping team there. So that's just a resource that we do for all of our members, where we are meeting with that person every single quarter, not just once a year or twice a year. We're meeting with you and checking in with you every single quarter to stay up to date with the windfalls and the downfalls in life. So if somebody's having a downfall in some, pardon my French again, but if shit hits the fan, we are there to help them and strategize with what they have with their policy. So most of the time, the focus is, just based on that person's needs, whether it's debt payoff, they want to invest with the money, saving for a large expense. But as that relationship builds with their money mentor and then also the implementation team, I would say about around month 8 to 9 is when that conversation starts happening of, all right, well, let's look at your family and all of your assets here and how much death benefit you have on yourself. Are we underinsured? Do we need more? Can we afford that convertible term as well? Right. And so that's kind of when we start having the conversation.
Cool. So is convertible term and insurability coming first, or is it a secondary thing after they've, like, what's the order?
Yeah. Order. Number 1, solving the money problems.
Okay, the cash flow problem.
Cash flow problems.
Okay.
Number 2, then we get into the insurability problems.
Okay, that's interesting, because I would say we try to do a mix. Obviously, you try to do both, but we definitely that's probably where we flip, because I would rather have someone get their insurance taken care of with the ability to convert to cash flow versus the difference there. So that's interesting. What have you? I have so many questions
Wait,
that I want.
and actually, Caleb, that kind of reminds me though. But I guess why we're a little different there is because my philosophy is always, if I can help solve your need for finance and cash while you're living, you will have enough death benefit to your family and heirs. And so
Right.
I follow that
But
mindset.
I think it takes time, right? It takes time. If you're starting at 200, like where you, and I don't want to put words in your mouth, but you're like, hey, if someone has $200 or $300, we're going to start a policy. We're going to figure out their cash flow thing. Then when their cash flow thing is figured out, then we're going to buy more life insurance.
Because it's disciplined.
Right. Whereas I would be like, okay, what kind of life insurance do we need? Let's make sure to secure that. And then let's figure out, do you have an additional cash flow? And then we go to converting that term in tranches from a standpoint. So that there's not a right way or wrong
No
way.
right way.
I just like, I think, again, part of the risk that we have in the insurance space is if people, like, we are in the protection business. And so we want to be able to make sure that people that are our clients, at least they're signing something, or at least they're aware that's like, hey, they talked to someone that represents life insurance. At least they're signing off and saying, hey, I would rather do a permanent policy and not do the term insurance, and here's why. So I don't know if you guys do that, but it's always fun talking through the different perspectives that people have.
We don't get these conversations. You're all the way in Denver.
Well, in Nashville, but the thing is, this is what I love, because we go on podcasts all the time, but like we only can go high level. We can't go deep like this, and so we got to have more conversations like this. Is there anything that your dad or the money multiplier team teaches that you disagree with, or like? And again, I'm not here to try to create drama here. I'm just like, is there anything that you're like, hey, Chris says this, but I disagree with that, or your dad says this, I disagree with that, or Mr. Burr or someone else on your team teaches it and I do? Because the reason I ask that question is I think it's really valuable for people to contrast, like, what are things that you taught early on that you regret and all. And I ask these questions because there's wisdom in the sometimes friction and disagreement versus the we all get along, we all agree. A lot of times there's less growth there because there's no stress on the muscle.
Yeah. I would say the biggest one is, hey, put your money in and then take it out right away, right now. I just, when folks are saying that, I get it. I get why people want to put emphasis on it, because when they're teaching it to the public who has never heard about this, and it's definitely just a mindset shift, they teach it in that way just to get the point across that it's liquid money. Hey, and my definition of liquid money is I can turn this asset into liquid cash within 30 days. So that's my definition of liquid. But so I think there's some people in this space that sometimes over glorify the put it in then take it out right now, where I don't think if you are in a place where you don't have any use for the money, or maybe you're saving up for something, I don't think there's any better place to store that money than back inside the policy. And then also, y'all pay back your policy loans, right? Didn't we hear that this week? Which there's some questions I want to ask about that. But
Well, just what you're referencing, the insurance company that we listened to, the executive, he almost made it sound like outstanding loans are a bad thing from the insurance company standpoint. And if you think about it, if everyone took policy loans like what you and I teach, insurance companies would have a problem. And I think that needs to be talked about more. And I'm hoping to talk to executives to say, hey, this is all great, but like, what are the downfalls if this message gets out to more people? Because insurance companies are a cash flow business as well. And the reason they may or may not like loans is, yes, they're making interest on those loans, but they're able to make more
out elsewhere.
So just like that's why we take loans, is to be able to make elsewhere. So it's just like
It's like a double-edged sword.
It's a double-edged sword, and I
Yeah.
think that's where it's like, as much as I love the concept of becoming your own banker kind of deal, if everyone did it, the question would be, would the insurance companies
Is
be
it
able
sustainable?
to sustainable? And I would say no. So it's just one of those things that it's like, it's interesting to say that out loud. But I don't think we have much to worry about, mainly because the reason I say that is in most insurance companies, less than 10% of the entire portfolio is outstanding loans. And those are the ones that are probably high banking style policy. So the reason why it's not a huge concern is like, there's so many people that have traditional life insurance that don't ever plan to take it for income or take loans against their policy.
Or just even, the people who want to use policy loans right away for paying expenses monthly. I think there's some, me personally, I don't do that. I go put the money to work and then have those investments pay
You're not
my
a fan
lifestyle
of people funding their life insurance policies and paying their cell phone bill and grocery bill and all.
immediately.
Yeah, but you are a fan of people paying their lifestyle expenses, because I'm not
In my retirement years.
okay.
Mhm.
Okay, yeah.
Taking out those tax-free withdrawals at that time, maybe not even withdrawals at that time. Maybe I'm just going to still keep taking out policy loans. I'm still in a conversation with myself about that.
I mean, you
But
got
I don't
time.
have to
You got
worry about
time.
that right now. But I right off the bat, it doesn't make sense to me, right? I mean, if I'm going to go spend $100 at the grocery store and taking out a policy loan, now I'm paying $105, right? I just think there's better ways to go put that capital to work even harder to create those passive income streams. So then come the time of retirement, I got my cash flowing assets plus the policy cash to fund the lifestyle.
Yeah. Anything else that you would like to share from a standpoint? It's very crazy how time flies when you're having fun. But anything that you're like, hey, these are insights, or I saw that you were reading The Psychology of Money. Is there anything that you're learning or thinking about that you're like, hey, this would benefit an audience that knows about life insurance, that may has heard about life insurance, that we can go a level deeper, but less about life insurance and more about life? Like, just for the record, life insurance is only valuable because of the tool. And the reason I talk about it a lot is it's just not talked about a lot, and it's very misrepresented. That's why I talk about it. But that's, at the end of the day, I'm going to be talking about lots of other things, but I just want a solid foundation base of content like this so that I can send people back and say, hey, watch this for perspective. So anything else that you would leave our audience, and you're young, so if you're speaking to someone young about some of the money principles that you've learned, what would those be?
What I was actually thinking about this. This might be TMI, but I was thinking about it in the shower just not too long ago. But money is so simple. Isn't it crazy how simple money is? But all of the noise and the BS that baby boomers and other generations older than us have learned throughout their lifetime, or maybe trusted financial institutions, government, and then they have to go in and reframe their mindset, or rethink their thinking, that it's harder for them to grasp these different philosophies and ideas about money. And so I don't know if it's just because of my age, or because I kind of make the joke, I've been around this stuff since I've been like pooping in my diapers, but it's so easy and simple if you just understand how to keep the money that you're already making. That's what people fail at. They just think that, hey, if I'm start making more money or doing more riskier investments or whatever, that I'm going to be profitable and more, and thus my expenses start rising. I go buy nice fancy cars and go do all of this stuff, and I like to show off. But it's just like I think the biggest thing is that money is so simple. Don't overcomplicate it, and keep the wealth that you're making. It doesn't matter how much you make; it only matters how much you keep. And I think that's where people kind of lack.
It's good. Anna, you're single, correct?
I am.
What do you have a list of like ideal person? I mean, there's a lot of people watching this, listening to this, and they're probably like, "Oh my goodness!" Like, is there anything that you're like, my future spouse has to have X, Y, and Z checked it? And hey, if you get hit up and they say BetterWealth podcast, at least give them a date. At least give them a phone call. That's my ask.
No, dude, because honestly, I do not want to get back on the dating sites. I got into a 2-year relationship that should have just stayed like a sorry mom, but one night stand, right? So it's hard, especially because I mean, what do people our age do? I mean, go out to the bars. That's where you go meet people. I don't want to go to the bars all the time and go do all that shenanigan stuff, right? So most of the people that I'm actually meeting are at like these conferences, or
Right.
when I go out and I speak, and they're in
So
the real estate
what is the
groups.
list? If you had to come up with like the top 5 things that you want, because again, my hope is if someone's watching this and they're checking some of the
Now your
boxes.
show is turned into like a dating service match.
Listen. I try to help out my friends.
No. I would say definitely wanting our goals align. I would say that's number one, our goals align. I would have to say, they still want to have fun. They still have that childlike energy within inside of them. Definitely handsome, right?
Yeah, they
I
got to be
mean,
good looking.
they gotta be good looking.
Yeah.
They gotta make me laugh,
Yeah.
right? But
Hardworking.
the hardworking has a
Yep.
good hard work ethic. But also just supporting what I'm doing too. I actually there for a while. I actually thought that I wanted like a house husband. I was like, well, I could do this all on my own. I just need somebody to cook my meals and do my laundry and make my bed every day and feed the kitty cats. But no, I've learned that, okay, Hannah, that's not what you want. You want an equal, right? But I would say number one is that our goals have to be aligned. For instance, a real short story. It's just like I look at my dad and I look at my uncle, dad's brother. Uncle Tug is totally happy living on a sailboat, being a botanist, sailing around. But then dad, has other aspirations where he's a plane enthusiast, right? And he likes to travel, and he wants to go visit this house, and then next weekend he wants to go to that house, which is totally fine. I think that's what's amazing about us living here in this God-given earth we call America. But my person, they just need to align with my lifestyle, my goals, and my values in that direction. And I think that's where I've been kind of lacking in my exes.
Well, I look forward to seeing what the future holds, and who knows, this stuff gets seen by lots of people, and the money multiplier has a huge movement and community, and so you're loved and appreciated. And so, Hannah, any final words that you have for our audience?
No, I just need to get you on my show. So
Make it
I'll
happen.
hit you up.
Let's make it happen.
Yeah, and we got your event coming up here soon, so I
Yeah.
look forward to
Yes,
it.
and probably at the time of this recording, it's already going to be done. But I just want to say, if you are a producer, if you're someone that's like watching this and you're watching this actually because you want to help more people, like there will be a link down below, I'm sure, just as a call to action, whether it's our feature events or whether it's something else. Like I would just encourage you, please reach out. Like we want to help you, whether you're a consumer and you want to understand like how to incorporate life insurance in your own life and your family, or if you're someone that wants to like get into this career in this business or in this business and want to thrive, we'd love to help you.
Community is everything.
Community is everything. Hannah, thank you so much.
Thank you, man.